Thank you for joining us for this webinar update with Rhett Kessler, Chief Investment Officer and Portfolio Manager for the Pengana Australian Equities Fund. My name is Luke Deland from the Pengana New South Wales distribution team. For those of you who've attended these sessions before, you'll know these updates generally focus on the reporting season that we've just had. However, given recent market volatility, unpredictable US tariffs and their effects on global trade and economic growth, today's update will also address some of those macro events and the opportunities they provided Rhett and his team to take advantage of, and the decisions they're making when it comes to stock selection and portfolio construction. Rhett will present for about 25 minutes, which will leave plenty of time for Q&A at the end. I do encourage you to ask any questions that you may have, and you can do so by entering them via the icon at the bottom of your screen at any point throughout the presentation. And with that, I'll hand things over to you, Rhett.
So today I'm going to cover off on a few things. I'm going to talk a little bit about just reminding you what the fund was set up to do, then talk about our performance, and then give what I hopefully will not be too boring, but an in-depth understanding of how the portfolio has adapted to the mouth-watering opportunities that were presented to us during the recent volatility. Starting off with the screen you see in front of you now, we always try to have a picture on the front page that indicates, what are the themes that we're following. The one today is a lady who is effectively leaning in to the opportunities. And what has happened in the past is there's been very short windows of opportunity to take advantage of opportunities that present themselves. What has happened through a mixture of the massive passive movement where people are following indices rather than fundamentals, and you get these momentum builds, and then you get fear around various political and macroeconomic issues. It's created very wide windows of opportunity for us to really get involved in building a stake. And these very wide opportunities have been so wide that to some extent you start wondering whether you're barking up the correct tree, or you're sure about your conviction. But it's allowed us to do a lot of channel checking and recheck our numbers and go to the suppliers and the customers and the competitors and build really solid investment cases again and again. And that requires a lot of courage and conviction to lean into these ideas. Now, you've had massive dislocations, and that's really provided a multitude of opportunities to the extent that we have gone from what has been effectively, more than 20% in cash to quite a low level in cash in the single digits. So we've really deployed a lot of money. And that's really all I was trying to demonstrate with that leaning in picture. Now, if I move on to the next slide, we still remain absolutely convinced that what investors really need is their capital preserved in real terms and a reasonable return for the risk we're taking on. And that we define as whatever the risk-free rate is, which is currently 4.1%, according to the Reserve Bank of Australia, plus a very consistent equity risk premium of 6%. So currently we need to deliver 10.1%, drive away, no more to pay. The investment process hasn't changed. We've been very consistent over the 16 years that we've been in business, idea generation, assessing the opportunities, and then crafting the portfolios. A little bit more detail in how we do this around about idea generation. We ask ourselves, is it a good business? And then we ask ourselves, can we acquire it at the right price? And I'll go through that with some practical examples in a little while. So how have we done? This is our 16-year track record. As you can see, the dotted blue line is our annualized return since inception. We know we had our one negative year, big negative year in fiscal year 22, and we spent significant time making sure that we repair the damage done in 22, and I think we've done a pretty good job in that. Can I just highlight that it looks today's the last day of April, and it looks like we have moved comfortably within our annual target. So we've had a very, very strong month. In terms of the returns, so we're on the blue line at the top. That's the returns you've received if you've been with the fund since the start. The green line is that benchmark that we have to stay ahead of. And now we're comfortably above that after this month. But as you can see, it's steepened quite a bit as interest rates picked up. And if you've been in the index, you can see that the grey line further down, and then you've got the RBA cash rate ticking along at the bottom. I want to stress that over the last 20 years, a whole generation has just been educated that, you know, if you've got long duration assets, which are equities and property and various others, that it's really just hanging on to those and she'll be right. But I wanted to highlight that over this period, you've had interest rates from the early 90s coming all the way down from that record level down to a very low level where they were practically nothing. And that is really, that ever decreasing cost of money has really driven an increase in the valuations placed on long duration assets. We've had a bit of bumpiness since then, but we're back at long-term levels. So 4% is about where the long-term average has been. Remember, when we started the fund, it was about 7%. And so we feel still very comfortable that we can generate that risk-free rate +6. We have a high-level view of the current environment, and I'll go through this very, very quickly. But we think that, you know, all the talk about higher interest rates, concerns about house prices, cost of living, is certainly being increased by the recent political activity, which culminates in the federal election this weekend. This weekend. But the input that we have is that the maximum point of pain has been passed. Now, inflationary pressures still remain, but consumers have definitely adjusted their spending, and wage increases have helped. Discretionary sales for companies have rebased, but costs remain problematic. So wages are going up at 4 to 5%, and lease costs are going up at 4 to 5%. And that puts quite a bit of strain if you're only generating very low single-digit revenue growth. It puts a lot of strain on trying to grow your profit if your costs are growing at significantly more than that. Now, in terms of the outlook, obviously the big news is all about tariffs. Frankly, it's not something we try to guess. I don't think anyone knows what Trump's going to say tomorrow. We certainly don't. And so we don't try to play in that environment. What we do is fundamental analysis on our typical toilet paper and toothpaste type businesses. But obviously, US tariffs will have some impact on the Australian market, particularly around Chinese demand for our iron ore, which is our major export. We do expect interest rates to be down and to come down over the next year. But importantly, we've taken a lot of advantage of this, I call it the Trump tariff tantrums or the Trump-driven volatility. We've seen concrete evidence that unsupported growth-based valuations remain vulnerable. So anybody missing these massive growth numbers that people have been expecting has seen very, very sharp sell-offs. We're not playing in that area, but obviously we're waiting for them to come back to fundamental valuation range. I do think the domestic consumer in Australia has been very resilient. Employment remains high. Higher interest rates than a couple of years ago have certainly supported the wealthier cohorts who are benefiting from higher interest income, and we're seeing that reflected all over. And then you've got this mismatch, this enormous mismatch of supply and demand in housing, which is putting a lot of strain on cost of living. And I'm going to give you some concrete examples of how we've taken advantage of that. I did want to show over the last few weeks or months or two, just what has happened to stock markets. This is a reflection of what's happened in the US, and it really has been incredibly volatile. And it's something that we embrace. We don't think we know what the absolute valuations are for many stocks, where we feel we can predict their future cash flows. And so we have been remarkably active over the last couple of months. I did put a quote in at the top here in the capital letters. Oh boy, that escalated fast. And it really got out of hand. And that's exactly what happened. You went from the honeymoon period of Trump winning and the impact on the elections to some of the statements he's made and the Liberation Day, and you can call, there's lots of sound bites that have been used to describe what he's done. But yeah, I think we've seen the actions. So the bifurcation has started to unwind. And by that I mean is that there's growth at any price for sexy stocks. And then there's the boring, stable cash flow producers that have been really left behind. And that's been the bifurcation between those two. It's also been exaggerated by what I'm calling massive passive, and that is the index funds have really piled in. So particularly in Australia, you've got CBA, which is the most expensive bank in the world. It makes up, I think, 11 to 12% of the index in Australia. So that means that for every $100 that goes into an index fund, the index fund managers are required to put $10 to $12 of that into CBA, and that's been driving the price significantly. As I mentioned right at the start, we've done a strategy of leaning in due to the wide windows of opportunity, and the high conviction's really paying off. We sold our expensive defensives, and I spoke about that earlier as well, challenging revenue growth, but cost growth is quite high. I think the banks were ridiculously expensive. We sold all our CBA at $156. We thought we probably held on a bit too long, but we eventually sold it. It's now trading at 165. I think CBA is a complete outlier. Sold half our position in NAB above $40, and we've since bought back a bit in NAB, and we've since actually started a new position in Westpac. So within the last 6 months, we've been extremely active. As I said, we've converted probably a quarter of the fund's value into equities, from cash into equities. We have trimmed or sold completely our expensive defensives. So Woolworths, CBA, Endeavour, Calcium was a mistake, and we've sold that. So that was a while ago. We also trimmed ResMed and Aristocrat significantly, and more recently we've sold, or trimmed, I should say, Telstra, Evolution Mining, and Medibank. But I still have meaningful holdings at each of those. Paradoxically, we bought back quite a bit of ResMed and Aristocrat, as they sold off, and we bought them back, and they're back hitting close to all-time highs again. Where we've been particularly active is in what I call the toilet paper and toothpaste type business. So we have bought into global packaging business Amcor on the back of its big deal that it's done with Berry. We think that's on 12 times earnings, which is about an 8% after-tax cash earnings yield. I think it's got a lot of upside, and that is now a very decent position in the portfolio. IAG, we thought we'd missed that, came out with a sensational result. I think the market got a bit panicked by the fact that they didn't raise their guidance. Just to give you an understanding of the short-term nature of the stock market there, the stock fell 15 to 20%, and we pounced, and we built a really decent position in that before it's rebounded. LD, we might have bought a little bit early, but we've built a really good position there. That's the old Ampol or Caltex brand in Australia. Our two positions in trying to take advantage of the lack of supply in housing and the massive demand is really Mirvac, that's MGR, and Stockland, SGP. Those are both companies that we've done extremely well out of, and we have approximately 8% of the fund in those two companies. I've mentioned already that we bought Westpac. I think that Anthony Miller is going to do a good job, and it got really, really good value. We've bought that extremely well. The two that are probably controversial is RHC, which is Ramsay Health Care, and James Hardie, and I'm happy to speak about any of those in questions later. I will just say in Ramsay Health Care, it's unusual for us because we've got a really big position in private health insurance. It's unusual for us to have Ramsay as well, but there's a restructuring of the private hospital industry going on in Australia, particularly with the demise of Healthscope. And I think that's going to play out really well. And then James Hardie, we got a small position in, and I'm happy to talk about that if there are any questions. So a few things to consider. We have been proponents of Telstra as a very attractive position in our portfolio. It makes up almost 7% of the portfolio, so it's a big position. A lot of people say that it's actually quite an expensive stock. We on a headline multiple, but I'll go through why I think it's definitely not. The main reason is because its cash flow is much higher than its reported earnings, and that's simply a factor due to it's caused by the fact that its depreciation is much bigger than its actual maintenance capex. And that's a historic reason. So we actually get a very high cash flow from this business. But essentially, it's got three factors going for it. First of all, it is the dominant mobile phone service provider in Australia, and that's 65 cents in every dollar that you put into the Telstra share. And that continues to grow remarkably well. It's also got a very nice infrastructure business, and you're seeing very high single-digit cash earnings growth there. It is probably the most defensive, non-elastic, based on price, service being provided in Australia, I think globally. Any of you try to take away Wi-Fi or mobile phone from any of your kids, or even your partners, or even yourself, it's just become an integral part of what we do every day. And this is the market leader in that, offering a really nice after-tax cash earnings yield. The Australian economy has been very resilient, and one of the danger points I want to point out is that government spending is really crowding out the private sector in two key areas. First one is in construction and building, and that's causing some of the problem between supply and demand for housing. But certainly in New South Wales, in Victoria, and in Brisbane, government spending on infrastructure assets has sucked a lot of capacity away from the private sector. Secondly, in NDIS, and that's in the healthcare services, NDIS has certainly crowded out the private sector, and that's creating opportunities, but also some stress. We've had full employment and very strong immigration for some time. I continue to remain concerned about social cohesion and potentially xenophobia. I think we're starting to see a bit of it, but hopefully be kept at bay. And then we've got the floating Aussie dollar, which has really worked out quite well for us as concerns about future exports of commodities as the concerns have gone up, the Aussie dollar's gone down, and that's buttressed the economy. I won't go through the private health insurance industry, but we certainly think it's going to continue to be very profitable. In terms of the top 10 holdings and sector exposure, I've been showing this slide now for probably 15 to 16 years. As always, defensive stocks are in beige, because beige is boring. but high quality defensive companies. And I've put them in order of declining order. I will point out that SG Fleet has an asterisk after it. That has been sold. Today, we should get our money for that position. It was a big bid from a private equity firm that's bought SG Fleet off for us, and that was about a 7% weighting in the portfolio at the bid price. So we've done really well out of that. But ResMed, Telstra, CSL, Stockland, Metcash, NIB Holdings, all really boring companies that just tick over and just generate cash flows. So that's the vast bulk of the portfolio. We have two resource stocks. We've been very brave, BHP and Evolution Mining. They're both lowest cost producers of iron ore and copper in the case of BHP, and gold in Evolution Mining. And Evolution Mining has been one of our stars. We have trimmed the holding, as I mentioned earlier, but it still remains quite a big position. There are quite a few numbers in this, and I do want to highlight that our cash level here is 5.9%. As you can see, I'll just put the mouse over it, but we've since got the proceeds from SG Fleet. So it was at 13%. It's currently around about 8%. So we spent quite a bit of money since the start of the month of April. Just really building those positions that we've spoken about. I do want to highlight as well that our after-tax cash earnings yield, and that's really the money that we think companies that we own are generating as a percentage, the cash they're generating, free cash flow that they're generating as a percentage of what we pay for those shares. And that is remarkably high at 7.6%. It would be a bit lower right now because the market's, our portfolio has gone up quite a bit during April. But at 7.6%, anything above 7 we consider quite high. And what that means is that over the year, all we have to do is sit and wait for that money to flow through to the companies, because they can then pay that money out to us as greedy shareholders or reinvest it in new earning streams or buy back shares. And so that takes the onus off the actual shares having to go up because they're generating so much cash flow. We also think on average, the companies we own have robust balance sheets in excess of what their needs are by about 5%. So examples would be ResMed is a net cash flow positive business, Telstra is undergeared, BHP is undergeared, Evolution Mining is now net cash positive, etc., etc. So they've got extra cash. They can either give it back to us as extra dividends, or they can use it to buy extra earnings streams. And so that 7.6% that I've got there, plus about 5%, gets us comfortably above our target of about 10.5%, which is the return we're seeking to generate. Like every other fund manager, obviously also think our shares are underpriced, and therefore we've got some capital appreciation as well. But we don't need to count on that because of the underlying cash flows generated in these businesses. Very, very different to owning maybe a realestate.com, which is on a 1% after-tax cash earnings yield. And therefore, you just really need upgrades in anticipated earnings in order to get capital growth. So I'm happy to come back to this slide, but I just thought I've probably gone on for a bit long, and I will finish off on a couple of themes and then take questions. So one of the themes we really like if you're trying to produce cash flows is making sure you're the lowest cost producer. And so scale and really good mousetraps and efficient mousetraps are really important. And so we thought in each of the categories we'd put how each of these companies are the market leaders. So the way of thinking about this is that the cost for a Telstra to produce a widget of data is significantly lower than Optus and TPG. And that gives them a whole extra avenue of creating additional value for us as greedy shareholders. And you could go through the same thing as NAB in their business banking. Medibank is the biggest private health insurer. BHP is the lowest cost producer of a ton of iron ore, etc., etc. The other one is a population growth thematic where we have seen probably strongest of most of the countries, industrialized countries in the world. The strongest population growth is occurring in Australia, mainly due to immigration. And that is seeing greater population, which is feeding through to the companies that service that population. And we're seeing that coming through really well. Lastly, I just thought I'd give an example. ResMed is our biggest position. It's over 7% of the portfolio. What are we buying? They basically supply flow generators, which are the things that sit next to people's beds that pump air. It's a reverse vacuum cleaner, and then masks, which make more money, than the flow generators because of the higher gross margins. Sleep apnea is, this is an incredibly strong business. It's a global oligopoly, or it's probably a monopoly now that Philips has fallen apart. It's globally diversified, large barriers to entry, and very much an annuity income from selling these masks. So every time someone buys a new flow generator, you could probably sell them three masks a year for the next 10 years. So really, really good business. Management's competent. They've certainly done a good job, and we've been able to buy it at the right price, which is a 6.1% after tax, 6.1% after tax cash earnings yield at optimal gearing. So I just thought I'd do that as an example. I've done the same with Telstra. Happy to go back to it if anyone wants to know, and with NAB. And so I think I've used up just under half an hour. And Luke, I think I'll throw it back to you for questions.
Thanks for the update, Rhett. We have had a number of questions come in, but just a reminder to those on the call that if you do have any questions, there's still some time to enter them into the Q&A box at the bottom of your screen. The first question we've got, Rhett, is obviously in relation to US tariffs. And whilst you're not focusing on predicting what Trump is doing with trade policy, but have you stressed your portfolio for potential tariff vulnerabilities?
Absolutely. And sorry, look, what I might do is just stop sharing so that we get a bigger screen like that. And just making sure that that works. So tariffs is all the rage. Every single investor is talking about it. I would like to just set up the framework. So first of all, US equity markets were very ritzy, were very expensive. And so we were always wondering what was going to shake the tree to create the problems. And to some extent, tariffs are obviously a big issue. And if it creates a recession, it's even a bigger issue. And if you could guess what Trump was going to come up with tomorrow, that would even be a bigger issue. So absolutely, it's been a big driver of investor sentiment. Now, typically, our portfolio consists of toilet paper and toothpaste type businesses that typically are not affected by these issues, but we have absolutely stressed them. I know way too much about the Nairobi Protocol of health services that ResMed sells and how they get a special exemption, potential pharmaceutical tariffs with CSL, and then things like imports and exports between the different countries. The biggest exposure we probably have is the fact that, and it's probably third or fourth level, is what happens to Chinese steel demand as a result of tariffs, and how does that affect the iron ore price? Now, even at a $10 a ton lower iron ore price, we can get a very decent after-tax cash earnings yield for BHP. And that's why we're there, rather than taking a view on, tariffs are or aren't going to create a problem for steel demand in China. And that's how we've treated each part of the business. I would certainly stress that the concern about the tariffs has created an enormous amount of opportunities rather than challenges for us, because equity markets in general have sold off. The after-tax cash earnings yields for companies not affected by tariffs have gone up as a result, and that's where we've pounced. So it has no impact on, for instance, an IAG or Ramsay Healthcare, but share prices have been much lower.
Yeah, yeah. Thanks for that. Next question is obviously it's in relation to lowest cost producers, mainly gold. Do you have a view on the gold price, as it feels like Evolution Mining could sell off pretty hard if we see a retracement?
Yeah. So we have trimmed Evolution Mining quite a bit. I do think it's a counterbalance to the rest of the portfolio. So, any concerns about a recession or future issues will, particularly stagflation, will be very positive for the gold price. If it doesn't happen, the other 95% of our portfolio will do quite well, but we like having it there as a balancing fact. Secondly, there are very strong underlying structural fundamental reasons why Jay Klein and Evolution Management have done a superb job on creating a well-diversified, lowest cost producers of gold in stable environments. So, they've got one in Canada and the rest is in Australia. And I think you're absolutely right. If the gold price goes up, we might not make 120% returns on Evolution Mining, but it's certainly, we may give back some, and we've banked some profits, but we're managing that quite carefully.
Yeah. Thanks for that. You touched briefly on population growth, but are there any opportunities to invest in the housing undersupply in Australia as a result, probably, of that population growth that we're seeing?
Yeah, so we've been looking for a long time, and this election's all about making housing more affordable, which I think is actually counterintuitive to what's needed. So every time they throw money at helping first home buyers or everybody else buy how pay more for their houses, that pushes up house prices. The single biggest issue, and sometimes I think it's just me, because no one else seems to be talking about it, but the biggest single issue is supply. And finding supply is, I think, the only way we're going to solve this. The two biggest manufacturers of new homes, Stockland and Mirvac, are in the portfolio in size, and we're very, very fortunate that the rest of their holdings, as in office and logistics mainly, got sold off quite heavily. So we could buy them on really attractive after-tax cash earnings yields. And so we picked up their home manufacturing businesses at really attractive rates. And that's starting to play out now. So we think we'll do quite well on that. Household formation, to some extent, we don't have any exposure in discretionary spending, but we're looking closely at a Nick Scalia or JB Hi-Fi, which we used to own. Maybe I don't think I'll ever own Harvey Norman, but due to corporate governance, but it's something we're looking at all the time.
Yeah. Okay. Thanks. Just switching to a stock that you are very familiar with now. There's quite a bit of news on CBA at the moment. It seems expensive, yet there's a lot of money buying it. Why did you sell?
Yeah. So we just sold it because it just, it was, we probably held on too long, as I said, but it got down to almost a 4% after tax cash earnings yield. So low, very low fives, for a very heavily leveraged business. The banks are very leveraged. It just didn't fit our process anymore. So we had to be disciplined and we exited it. And then there's a whole range of reasons why it's seen as the ultimate safety play. So as gold's gone up, I suppose CBA's seen as a safe haven as well. But it's, we just have to have a reason following our process that makes sense, that allows us to hold stocks, and it didn't anymore.
Okay. Next one is in relation to James Hardie. The recent acquisition was seen by some investors as overvalued. Can you explain some more of your thoughts on that deal and your thesis for acquiring James Hardie?
Yeah, so James Hardie, just to unpick this a bit, just so everyone's in the picture. James Hardie is predominantly a US based business that came out of Australia a long time ago, and they make this incredible product called a Hardie board out of concrete, really, and wood fiber, that is fireproof and is quite attractive when they build homes in it. And it's gone incredibly well in the States. They've gone from virtually nothing, no market share, to 30% market share for housing there. We think it's a great business. We think it's, we've owned it before. I just thought it was an incredible, one of the best mousetraps in the business. So it costs them very little to make the widgets, and they can sell the widgets for a lot of money. It got really too expensive, so it became, well over 20 PE, and we sold out stock. Approximately few months ago, they announced on a Sunday night, after big industry players had announced big downgrades in the industry, that they were buying ASEC, which makes composite timbers for decks. And is a US listed company, that they were buying it for an enormous price. And I guess everyone's seen in the news that shareholders didn't even get the right to vote on whether they wanted to issue, basically sell a third of the company in order to buy it. The share price got absolutely whacked, and it fell more than 40%. So, one way of interpreting it is we actually got ASEC, which is quite a good business. They just paid way too much for it. We got it virtually for free because we came in at a much cheaper price. And so I still like the businesses. I just didn't like the corporate governance. And I think there will be some very big impact on that. We've established a holding in it, but just over a 1% holding at what I think is a very, very attractive price.
Okay. You did mention earlier about the fact that it is unusual to hold both health insurers and Ramsay Health Care, but we've got one question. It's very like a very basic question. It just says, can you speak some more about your Ramsay Health holding?
Okay. So look, I think this is every now and then you get a generational shift in the structure of a really good industry. And I think private hospitals is a really good industry, particularly in a country where you have strong population growth and an aging population growth who will use this more and more. We have a very good public system, which is full. And so the government has, for many decades, used the private hospital industry to take the overflow and to create the skill base that supports the public system. Probably about 5 years ago now, I may be wrong, 4 or 6 years ago, Healthscope was sold to private equity. They leveraged it up at very low interest rates. It took a lot of money out of it and signed long-term leases at quite high rental rates. As we all know, three things have happened. One is utilization of private health of hospitals during COVID and since has declined. Secondly, interest rates have gone up a lot. And thirdly, because inflation's gone up, leasing costs have gone up for the hospitals. So most private hospitals, not Ramsay, but most private hospitals are under enormous pressure. If you've got a fortune of debt, like Healthscope does, you're under enormous pressure. So I think it's likely that Healthscope will not continue to exist in the form that it is today. There's about 32 hospitals, which is a big group. It's the second biggest group in Australia. And there are two components to it. There's good hospital group and bad hospital group within Healthscope, and they've already divided them into those two. I think good hospital group will get sold or split up amongst the different industry players, and we expect Ramsay will maybe get lucky and get some of those pieces. If they do, it's really game on, but we're not anticipating that. And we think the extra surplus capacity with bad hospital group will get sold off. Will get closed down. And that'll restrict capacity within the industry. Private hospitals are great businesses in terms of their fixed cost leverage. So the moment they go from 80% to 85% capacity utilization, that extra 5 just drops down to the bottom line. And we think that that'll happen. Now, I should just say Ramsay's got 2 other businesses besides Australia. One of them is very problematic. It's in Europe. It's in France and the Nordic countries. What's absolutely bizarre is the banks have lent them almost all the equity in buying those businesses on a non-recourse debt level. So we think Ramsay can just walk away from that. And we hope they do. Even if they sell and get $1, it'd be a great outcome. And that's what we're anticipating. And then there's the UK business, which is an okay business, but it's very small. You can currently, at the current share price, buy Ramsay Healthcare for less than what the Australian property that they own, so they own all their hospitals, are worth. And so we think it's a great opportunity.
Okay. Sticking to healthcare, this one's in relation to ResMed and the anti-obesity drugs like Ozempic, for example, have gained FDA approval for treating moderate to severe obstructive sleep apnea. Do you see this as posing a threat to ResMed's CPAP therapy?
So I know that all the scaremongers, well, I wouldn't call them scaremongers, but all the negative concerns about ResMed relate to the GLP-1s and the fact that no one's ever going to buy another sleep apnea device because no one's going to need it because everyone's going to be thin. But I think rather than being a threat, I think it's a massive opportunity. And I'll just go through my thinking. First of all, only a portion, admittedly a big portion, so maybe 30 to 40% of sleep apnea is caused by obesity. The rest are physiological issues, altitude issues, and a range of other issues. But it does affect a big component. The gold standard of care at the moment is to get yourself, if you come in complaining about sleep apnea or obesity, is to get yourself sleep tested. Because if you've got sleep apnea, it slows your metabolism, and that's one of the reasons why you put on weight. What has happened over the last 2 years, and we have quite detailed information on this, is that the pharmaceutical companies are throwing hundreds of millions of US dollars at advertising GLP-1s, forcing or driving a whole lot of people to see their doctors. They come in, the first thing the doctor says, well, you might have sleep apnea. That's why you're overweight. Standard care is go for a home sleep test. Home sleep testing has gone through the roof. It's up 20, 30%. When people come back to see the doctor, they say, right, you've got sleep apnea. I'm going to write you a prescription for a medical device from ResMed, and I'm going to write you a prescription for GLP-1. The guy obviously doesn't want to wear a mask. It's not that sexy. He goes away and takes the GLP-1 and he loses weight, not enough to stop his sleep apnea. And after a while, he feels so bad that he goes off his GLP-1s and he puts on the weight and more. And then he definitely goes to full, if he hasn't done it before, his sleep apnea device. So you've seen penetration of sleep apnea devices pick up quite a bit. And so it's actually driven more and more traffic into this funnel. And every time the results come out, they indicate that that's what's happening.
Okay. We might ask one more question in the interest of time. This one's in relation to your current cash balance in the portfolio, Rhett. You went into the recent volatility with a healthy cash balance, which has largely been deployed now. How will you think about liquidity if the sell-off or / volatility continues?
Yeah, so it's a really good question, one we think about every day. I mean, there's a real luxury to having lots of cash, right? If you're worried about capital preservation, but then you'd be, I think, you'd be completely negligent if the opportunities presented themselves and you didn't grab them with both hands, right? So we've demonstrated that we've been waiting for something and then we've been active. That's the first thing. The second thing is it's where we've been active. We've been active in big liquid stocks where our ability to, where liquidity is high, and so we've got flexibility. Thirdly, I just want to stress we're down at 8.5% cash and still finding opportunities. So we will continue to deploy it. It's not like we're done. I know most of my peer group would be consider running a 4% cash balance quite high. But we've still got lots of activity. We've also got a couple of things we want to do in the portfolio. We want to liquidate a few positions that'll generate some cash. So very much business as usual, but certainly in a big cash deployment environment. I really do want to stress is we don't think we want a lot of cash because we're nervous, or we want no cash because we're optimistic. What happens if opportunities present themselves? We'll deploy the money. What happened while we had 22% in cash effectively was because there weren't any opportunities available, right? It wasn't because we were nervous. We just thought, we kept looking for things and we couldn't find them. And for a long time, I felt like maybe I needed the straitjacket because, I was the crazy one. But so I do want to stress that underlying cash flow fundamentals are back in vogue. I think they'll be around consistently, and that's it's our time to really take advantage of that, and we have been, and as you'll see from the numbers at the end of today, that we really have taken advantage of it.
Yeah. Well, thanks for that, Red. This has been a very comprehensive update. We did cover off a lot. Is there anything else that you might like to sort of mention just before we wrap things up?
I think it's been a while since I've enjoyed myself as much as I have over the last couple of months. I know that seems a bit counterintuitive given how beaten up a lot of people are from markets, but we've really enjoyed. It's been tiring, but we've really enjoyed ourselves, and hopefully the fruits of that activity will become evident.
Yeah. All right. Well, thank you. Also, in the interest of time, I will wrap things up here, but thank you to all those of you who did submit questions. If you didn't hear a version of your question answered, we will respond to you directly. Our next webinar update is actually tomorrow afternoon at 12 p.m. with Amy Pham, Portfolio Manager for the Pengana High Conviction Property Securities Fund. If you haven't registered for that, you can do so via our website at pengana.com. And with that, thank you, Rhett, and thank you all again for attending, and enjoy the rest of your afternoon.